92.6% of active large-cap funds failed to beat the S&P 500 index. This failure occurred over the 15-year period ending mid-2023. The SPIVE U.S. Mid-Year Scorecard confirms this devastating statistic. This massive failure rate is consistent across global markets. It applies equally to mid-cap and small-cap funds. Active managers must generate alpha to justify their high fees. Alpha is the return exceeding the relevant benchmark index. Consistent outperformance is required for fund manager success. The goal is to beat the market average after all costs. Long-term data shows sustained alpha generation is statistically improbable. The vast majority of funds cannot overcome the mathematical hurdles. Investors pay high fees for statistically guaranteed underperformance. Understanding this failure rate is crucial for your investment strategy. We will break down the 9 reasons why this failure is unavoidable. Active management fees are the largest mathematical impediment to beating the index. Typical active equity funds charge expense ratios between 0.75% and 2.00% annually. Passive index funds often charge less than 0.10% per year. A fund charging 1.5% must generate 1.5% gross alpha. This gross alpha is needed just to match the zero-fee index fund return. The fee is deducted regardless of the fund's actual performance. This makes the expense ratio a guaranteed drag on all returns. Over decades, this compounding fee differential creates a massive performance gap. For example, a 1% annual fee reduces a 30-year return by nearly 25%. Investors must overcome this substantial cost hurdle every single year. Low-cost indexing immediately eliminates this guaranteed performance drag. The fee structure alone ensures most active funds cannot compete long-term. Beyond explicit management fees, active funds incur significant frictional costs. These costs result from high portfolio turnover rates. Active fund turnover frequently exceeds 50% annually. This means half the portfolio is replaced every single year. These trading costs include commissions and regulatory fees. They also include the cost of the bid-ask spread. The bid-ask spread is the difference between the buying and selling price. Large institutional trades suffer from significant market impact. Market impact occurs when buying or selling a large block moves the price. This movement is always against the fund's desired transaction price. These hidden trading costs easily add another 0.5% drag. The drag can even reach 1.0% on annual performance. This further widens the performance gap against low turnover index funds. Index funds typically have turnover rates below 5%. High turnover is necessary for active managers seeking alpha. However, high turnover guarantees higher costs and lower net returns. The aggregate return of all investors must equal the market return itself. This is a fundamental arithmetic identity of the capital markets. Passive index investors simply hold the entire market portfolio. Therefore, the group of active investors must collectively match the market return before costs. Active management is fundamentally a zero-sum game before any costs are considered. For every active investor who outperforms the market, another must underperform. When substantial costs are introduced, the equation changes dramatically. These costs include management fees and frictional trading expenses. The active group is mathematically guaranteed to underperform the passive group after costs. Active management transforms from a zero-sum game into a negative-sum game. The total wealth generated by the active group is less than the market return. This structural reality makes long-term collective alpha impossible. Modern stock markets operate under extremely high informational efficiency. This is especially true for large-cap equities. Millions of highly skilled analysts process new information instantly. Sophisticated algorithms analyze data and execute trades within milliseconds. Any temporary mispricing is quickly arbitraged away by these participants. Sustained outperformance requires the manager to possess a persistent informational edge. This edge means having non-public information or superior analytical skills. The manager must consistently exceed the collective market intelligence. The sheer volume and speed of information dissemination make this edge virtually impossible. Public information is already priced into the stock instantly. Active managers are essentially competing against the entire financial world. This competition ensures that only random chance drives short-term outperformance. True alpha generation requires concentrated bets on a small number of undervalued securities. High conviction positions are necessary to significantly deviate from the benchmark. However, active funds face strict capacity constraints and regulatory requirements. The Investment Company Act of 1940 mandates diversification for most mutual funds. This legal requirement mitigates risk for the fund holders. It simultaneously forces active managers to hold dozens or hundreds of stocks. This broad holding inevitably causes the portfolio composition to drift closer to the index. This phenomenon is commonly known as closet indexing. Closet indexing prevents the fund from achieving the necessary deviation. Without significant deviation, substantial outperformance is impossible. Managers cannot take the concentrated risks needed to generate massive alpha. Regulatory constraints thus ensure median performance for most diversified funds. Active managers are susceptible to the same behavioral biases as individual investors. These biases include confirmation bias and anchoring effects. Loss aversion often prevents managers from selling losing positions quickly. Furthermore, career risk heavily influences investment decisions. Managers are incentivized to avoid extreme deviations from the benchmark index. This pressure leads directly to widespread herding behavior. Managers often buy or sell the same popular stock simultaneously. They do this to avoid the risk of being wrong alone.
This occurs even if the manager suspects the stock is overvalued. Collective behavior reinforces existing market prices. This conformity significantly reduces the opportunity for independent alpha generation. Following the crowd ensures the manager will not be fired. It also ensures the fund will not significantly outperform the market.
Active management creates a significant tax drag for investors in taxable brokerage accounts. High portfolio turnover generates frequent realized short-term capital gains. Short-term gains are taxed at the investor's ordinary income tax rate. These rates often exceed 30% for high earners. Passive index funds use a strict buy and hold investment strategy. This strategy minimizes the realization of capital gains. Index funds primarily generate long-term capital gains when shares are sold. Long-term gains are taxed at lower preferential rates. This tax inefficiency further reduces the net after-tax return of active funds. The tax burden compounds the performance gap created by fees and trading costs. Investors lose a substantial portion of their gross returns to unnecessary taxes. Tax efficiency is a critical component of maximizing long-term wealth. Regulatory frameworks impose strict limitations on the strategies active managers can employ. Rules govern the use of leverage, short selling, and complex derivatives. These restrictions limit the ability of funds to take high-risk positions. High-risk positions are often necessary to generate massive alpha. For example, UCITS regulations in Europe impose strict liquidity requirements. They also mandate specific diversification levels. These legal constraints are designed primarily to protect retail investors. However, they simultaneously prevent managers from exploiting aggressive strategies. Aggressive strategies might lead to significant outperformance. These rules ensure that most regulated funds remain close to median market performance. The legal structure prioritizes stability and risk mitigation over maximizing potential returns. Compliance with these rules inherently limits the potential for extreme alpha generation. The cumulative effect of all these factors makes sustained outperformance nearly impossible. High fees, trading costs, and market efficiency create insurmountable hurdles. Regulatory and behavioral constraints further limit alpha potential. The 90% failure rate is not a coincidence or bad luck. It is an arithmetic certainty derived from the structure of capital markets. Index investing captures the full market return, known as beta. It achieves this capture at the lowest possible cost structure. Maximizing long-term wealth requires accepting the market return. This is achieved through disciplined, low-cost indexing. Paying high fees for active management guarantees statistically certain underperformance. Indexing is the default winning strategy for the vast majority of investors.